There is a hidden financial system operating right now in the shadows, worth approximately $750 trillion. To put that number into perspective, the entire world economy, every good and service produced by 8 billion people in a full year, is roughly $105 trillion. The shadow banking system is 7 times larger than all human economic activity combined. It is bigger than all the world's stock markets, all the real estate, all the gold ever mined, all the Bitcoin, and all government debts added together, and still has hundreds of trillions left over. And almost nobody outside of a tiny circle of central bankers, hedge fund quants, and private credit billionaires even knows it exists. This is not science fiction. This is the narrow plus broad measure of non-bank financial intermediation, tracked by the Bank for International Settlements, the only institution that even attempts to measure the whole beast. In December 2025, they published their latest update and used words no central banker likes to use in public: systemic vulnerability, acute liquidity mismatch, hidden leverage, and the single largest risk to global financial stability. They were not talking about JP Morgan or Deutsche Bank. They were talking about the shadows. So, what exactly is this shadow banking system? It is everything that acts like a bank, but is deliberately structured not to be called a bank, so it escapes capital requirements, liquidity rules, stress tests, deposit insurance, and basically all adult supervision. It includes money market funds that promise you a stable dollar, 1.00 value, and same-day withdrawal while quietly lending your money out for years to over-leveraged companies. Overnight repo markets where hedge funds and trading houses borrow hundreds of billions every single night using bonds as collateral that can lose 20 to 30% of their value in a single bad day. Private credit funds that have ballooned to $2.7 trillion in the US alone, lending to junk-rated companies that no regulated bank would touch, with almost no secondary market and covenants so loose they're basically jokes. Chinese wealth management products and trust loans that local governments and property developers used to hide more than $13 trillion in debt off their official balance sheets. Securities lending programs, total return swaps, prime brokerage financing, synthetic prime funds, offshore reinsurance transformers, Cayman SPVs, Luxembourg SICAVs, thousands of legal entities whose only purpose is to create leverage without anyone having to report it. This entire parallel universe grew up for one simple reason. After 2008, regulators strangled the regular banks with Basel III, Dodd-Frank, liquidity coverage ratios, and endless stress tests. The banks looked at the new rulebook, smiled, and said, "Fine, we'll just take the exact same activities, move them 1 inch outside the regulatory perimeter, and keep doing them at 10 times the size." Mission accomplished. In 2007, on the eve of the last crisis, global shadow banking was roughly $60 trillion. By 2015, it had doubled. By 2020, it had quadrupled. And today, late 2025, it sits at $750 trillion and is still growing at roughly $80 trillion per year, faster than any government or central bank can even print money. Now let's talk about the 5 biggest landmines buried inside this thing that are already flashing red. First, the $22 trillion U.S. money market fund complex. That's more money than all U.S. bank deposits combined. These funds promise instant liquidity and capital preservation, yet 40 to 50% of their assets are commercial paper and certificates of deposit issued by highly leveraged corporations and European banks. We saw what happens when confidence cracks. In March 2020, the Fed had to inject $4 trillion in emergency facilities in a single week to stop a total run. That was when the sector was half the size it is today. Second, the global repo market, roughly $19 trillion on a typical day, almost entirely overnight or 1-week funding. The entire trillion-dollar hedge fund industry funds itself here every single night. Collateral values are marked to market in real time. If bond prices drop just 3 to 5%, margin calls hit instantly, forcing mass liquidation. This is exactly how Bear Stearns and Lehman died in 2008. The difference is the numbers are now 20 times larger. Third, private credit. $2.7 trillion in the US, another $3 to $4 trillion globally, and growing at 15 to 20% per year. These are direct loans to mid-sized companies with EBITDA fudged to the moon, interest rates of 12 to 20%, and almost no public disclosure. Over the next 36 months, more than $2.4 trillion of these loans come due for refinancing. The original loans were made at 4 to 6% interest. Today, the same companies would have to pay 15 to 22%. Most of them can't. Default rates have already climbed from 2% in 2021 to over 9% today, the highest since 2009, when the first big $50-100 billion fund announces it is gating redemptions or taking 40-cent haircuts. The panic will spread faster than any regulator can react. Fourth, China's shadow system, conservatively $300 trillion when you include trust products, entrusted loans, bankers' acceptances, and local government financing vehicles. Thousands of these products have already defaulted since 2023, but Beijing keeps forcing rollovers and hiding the bodies. The moment one major province or city openly defaults, and several are within months of that point, the contagion will leap the Pacific overnight. Because Western funds own billions of dollars of these wealth management products through Cayman and Hong Kong wrappers. Fifth, the hidden leverage monsters nobody regulates. Family offices, commodity trading houses, and macro hedge funds running 50 to 100 times effective leverage through total return swaps and prime brokerage financing. Archegos Capital Management was a $30 billion accident in 2021 that wiped $10 billion off the capital of Credit Suisse, Morgan Stanley, and Nomura in a single weekend. Today there are dozens of funds larger than Archegos that file zero public reports and operate with leverage ratios that would make a 2007 CDO trader blush. The fuse on this entire powder keg is painfully short. 2025 to 2028, the largest private credit maturity wall in history. 2026 alone, $900 billion of U.S. office and retail commercial mortgages roll over into a world where office vacancy is 25% plus, and interest rates are 400 basis points higher. 2026 to 2027, Chinese local government financing vehicles face $6 trillion in refinancing that nobody believes they can actually pay. Central banks are completely trapped. Inflation is re-accelerating, so they cannot cut rates aggressively without reigniting 2022-style price spirals. But they also cannot keep rates high because the entire shadow system was built assuming permanent zero interest rates forever. When, not if, the first major gate or forced liquidation hits, the sequence will be merciless and lightning fast. Day 1. A $50 to $100 billion private credit fund suspends redemptions. Day 2. Investors rush into money market funds for safety. Outflows hit $1 trillion. Day 3. Money market funds start dumping commercial paper. Rates spike to 15 to 20%. Day 4. Repo market seizes. Haircuts on collateral jump from 2% to 30% overnight. Day 5. Prime brokers issue $2 to $3 trillion in margin calls to leveraged hedge funds. Week 2. Fire sales crash bond prices, which triggers more margin calls in a feedback loop. Week 3. Stock markets down 60 to 80%. Corporate bond market completely shuts. No new issuance possible. Month 2. Global trade finance freezes. Container ships stop sailing. Supermarket shelves go empty in weeks. And this time there is no cavalry. In 2008-2009, the world committed roughly $29 trillion in bailouts and guarantees to stop the cascade. That was when the shadow system was 1/10 its current size. Today governments are already drowning in debt from COVID spending, energy subsidies, and decades of deficits. The U.S. national debt is $36 trillion and rising $2 trillion every 100 days. Japan is at 260% of GDP. Europe never truly deleveraged. China's hidden obligations are larger than its official GDP. Central banks could theoretically print whatever number is required, but the inflation math no longer works. The last $30 trillion they printed since 2020 directly caused the worst inflation in 40 years. Another $50 to $100 trillion round would destroy what little trust remains in fiat money. The dollar, euro, and yen would collapse simultaneously. Import prices would quadruple overnight, and civil unrest would follow within weeks. Politically, the will for another banker bailout is dead. The public watched the 2008 rescues save the bonus class while their wages stagnated and houses became unaffordable. The next time a politician stands up and says, "We have to save the system," the answer will not be compliance. It will be pitchforks. This is not a forecast. This is arithmetic. A $750 trillion financial system built almost entirely on short-term funding and extreme hidden leverage cannot coexist with 5 to 7% interest rates. The laws of mathematics do not negotiate. The cracks are already visible. Default rates climbing, funds gating quietly. Chinese trusts missing payments, repo spreads twitching, commercial real estate funds trading at 50-cent discounts in private secondary markets. 2026 is not the year this might happen. 2026 is the year the last domino finishes falling. When the hidden $750 trillion shadow banking system finally explodes into the open, there will be no safe corner of the financial world left untouched, no government large enough to contain it, and no amount of money left to print without destroying the currency itself. The only question remaining is how much time you have left to move whatever you can outside the blast radius, before the light finally reaches the shadows.